move now a little bit at the impetus for a change in the reference data space. John, is it more that firms are concerned about the cost, or are they concerned about the risk? Can you give me a sense of what's really motivating the institutions?
I think it's a number of things, to be honest. Cost is always a factor, particularly when you look at the impact of the last 18 months or so, where trading volumes have declined and revenues have declined within the banks. Then the bank's always going to look at maximising its value for money. And in an area where they're typically spending tens, if not hundreds of millions of dollars a year, then that's going to be one area that's going to get focused. So I think cost is always going to be an area. Certainly risk, regulation, yes, there are all other areas that the bank needs to be aware of. Risk in terms of exposure to a particular counterparty, or risk in terms of exposure to a particular instrument. We saw the significance of that with Lehman. So yes, I think risk and regulation are always going to be factors that will play a part, as well as cost.
Okay, John, so you just mentioned the Lehman Brothers. Obviously, that's a very well-known event these days. Can you explain to me a little bit more, for the benefit of the viewer, the relevance of reference data and the reference data challenge within the context of the collapse of a huge bank like Lehman's?
Well, I think Lehman's caught everyone by surprise. I was one of those who's actually sad enough to go onto the internet and find a diagram of the topology of the connections that Lehman's had amongst its over-the-counter trades with its credit default swap transaction, and it's as if someone's gone haywire with a spirograph. I mean, so people looked at Lehman's as if it were too connected to fail. They didn't think it would be let go. So when it did go, in terms of the impact that had, not only in terms of the instruments that people were on the other side of to Lehman's, but the exposure that people had to Lehman's. Understanding exactly, we come back to this transparency issue, understanding exactly the legal entity that they were dealing with. Goodness knows how many legal entities there were, probably in excess of 200, 250 or so legal entities that Lehman would be trading through. So aggregating all of those into a consolidated position to understand exactly what your exposure was to that particular organisation, understanding which instruments Lehman was on the other side of as the counterparty or the client, it illustrates just what an impact or the effect transparency around reference data can have, and being able to navigate your way through the reference data becomes critical in those sorts of situations.
I mean, so would it be overstating the case to suggest that had we had greater standardisation within the industry, that those people, those institutions who were exposed to Lehman Brothers would have known much faster than they did at the time? I mean, you've heard stories of people taking 2 weeks to work out what their exposure was.
I think that's fair. I mean, that's not an uncommon. If you go back in time, we had Long-Term Credit Bank, we had Bearings, we've had examples of where organisations have failed in the past, and people have scrambled to understand what that exposure has been. I think Lehman's illustrated that, but just on a much grander scale. I don't think anyone expected an organisation the size of Lehman to disappear as quickly as it did. So I think in that regard it is a fair comment to make that with greater transparency, with greater standardisation, people would have understood their exposure a lot more quickly. And potentially from a risk management perspective, they might have understood their exposure prior to Lehman's understanding, and therefore maybe being able to mitigate against it. But that's obviously conjecture and supposition on my behalf. But it's certainly a fair argument or a fair comment to make that I think people would have understood their exposure more quickly with more transparent data.
And finally, the big issue, of course, regulation. You mentioned earlier, along with cost, that regulation would be an imperative to change. But can you give me a sense of just, one assumes that the regulators at the moment are dealing with a lot of quite high-level issues relating to the structure of banks, capital ratios, all that kind of stuff. In terms of the nitty-gritty nuts and bolts of what goes on in the back office, and especially with regards to reference data, are they looking at those kind of issues, or is the pressure sort of more indirect, coming down from other regulatory initiatives?
I think the regulators are looking at it. I mean, obviously at the tail end of last year, we had the FSA fining Barclays for inconsistencies in their reference data around certain trades that they filed. I think they were fined something like 2.45 million. So the regulators are looking at reference data and the impact that has. I think there are also other initiatives, though. We have the initiatives from the ECB, we have the initiatives in the US. So there's no doubt that the regulators are taking a very hard look at what can be done about reference data, not necessarily just at the high level, but right down at the fundamental level. What do we describe things as? What language do we use to describe the product, so that we get it right much earlier in the cycle, rather than allowing the multiple codes and the multiple descriptions to then sort of run rampant further down the processing stream. So they are looking at it in quite fundamental terms, I would say, but I think it's open to debate as to how much and how far they'll step into the particular debate, be it in terms of legislation or be it in terms of just advising or suggesting.